A shrinking labor force, lower hours worked, lower growth, and lower earnings expectations. What is the future of investing internationally? Hey everyone, Nick Andreessen here with Oakley Financial Group. There is a world of investment opportunity out there, but given all these headwinds, how should you invest internationally? Over the last 30 years, outside of a short period in the early 2000s when China was included in the World Trade Organization, the US's stock performance has outperformed international stocks by a significant amount. So the first question is, why is that? And the second question is, will it continue? And the third is, how should we think about investing internationally from a risk perspective? Most outside of the investment community have not seen this chart. Since 1971, the relative outperformance of developed international over the US in the purple, and the US's outperformance of international in the gray. By developed international, we're pretty much talking about Europe and Japan, as represented by the MSCI EAFE index. China, India, Brazil, places like that fall into the emerging markets category. This chart is showing the developed international, although the US has outperformed emerging market indexes as well. So really, since 1989, it's been a US domination when it comes to investment performance. The most recent time period is from 2008 until 2022, a 14-year time period where the US outperformed international by 277%. The last major time period when international outperformed the US is back in the 1980s when Japan went on a tear and were going to take over the economic world. Remember that? John McClane does. Until, well, they aged out and their population peaked and began shrinking. They also had major debt problems that had to be dealt with. So why was this? Well, a lot has happened over the last 30 years, and the real answer lies in a trillion different data points. But in an attempt to simplify, I'd argue it has to do with demographics when comparing the US and Japan, and largely due to technology when comparing the US and Europe. And the US's domination in technology and innovation up to this point, starting with the internet and the web browser and iPads, to mobile, to streaming music, to streaming movies and social media, to crypto, to now artificial intelligence and language learning models, the US has led the way. The second question is, will it continue? I'm not one to make predictions about the future because by definition, the future is unknown. And from being in this business nearly 20 years, predictions don't work out very well for those who make them. But it appears as though the US will continue to lead in innovation for the time being. And from a basic economic growth perspective, the two largest variables are labor force growth and productivity. And productivity is pretty similar between most developed countries, but labor force growth has a fairly large divergence. And the thing about labor force is we have a good approximation of what it's going to be. For example, if you're 12 years old today, you're going to be 16 in 4 years. That's known. Here is the US's expected labor force growth versus Europe's. Notice any differences? The US is expected to continue to grow its labor force, even if it's leveling out, and Europe is in a little bit of trouble. The dark line is what we know based on birth rates, and the dotted line is expected birth rates in the future. If there are more births, then the dotted line shifts up, and if there are less, then the dotted line shifts down. Now, the biggest unknown variable of the next 5 to 10 years is immigration. More immigration, this line shifts up, less it shifts down. Demographics play a factor in expectations that the US will have higher economic growth and higher earnings growth over the next 5 years, and probably beyond that. So the third question is how to invest internationally. We believe there are great opportunities to invest internationally, and that it's an important component of a diversified portfolio. Europe has fantastic companies and industries in manufacturing and engineering and health sciences, and Japan is crushing it in robotics. Also within Europe, even though Germany has a falling labor force. France has a healthy labor force. There are growth differences between the European countries. So don't throw the baby out with the bathwater. But we're also aware of the landmines. International investing involves special risks such as currency fluctuation and political instability and may not be suitable for all investors. These risks are often heightened for investments in emerging markets. If you were to break down main ways to access international markets, it's 1, international stocks, 2, index funds, 3, active mutual funds. My take is this. 1, most people don't have the skill set or available time to be purchasing individual companies, more or less individual international companies, which can be a dangerous game. Remember, the person on the other side of the trade is probably some institutional investor. And 2, for the reasons mentioned regarding lower growth and lower earnings expectations, indexing is not my first preference because you could just be accepting that fate. Why would you invest in an area you feel has lower growth potential on average? My preference is gaining access through active mutual fund managers. These professional portfolio managers and their teams of analysts have the ability to sift through all the complexities and get to the companies where they think they have the potential to perform well long term. Yes, there's a bit of cost for the management, but it can be absolutely worth it given some of the risks associated that we talked about. Now, not every active manager is the same, so you have to still do your due diligence here as well. But do I think professional portfolio manager can find 50 companies throughout all of the international markets that have healthy balance sheets and growing revenue and strong profit margins? Yeah, I do. The point is, do I want to invest in 5,000 international companies and just gain international exposure? No. At least not if I can help it. But am I willing to invest in a manager who narrows it down to 50 great companies? Absolutely. Hi everyone, Nick Andreessen here again with Oakleaf Financial Group. If you want to learn a little bit more about us, you can go to our website, www.oakleaffg.com. The clients we work with typically come to us because they're afraid of running out of money in retirement. They feel they're paying too much in taxes. They want to improve their investment performance, and they want to make sure their family is taken care of should something happen to them. And we work with them to design the strategies in pursuit of these goals. But at the end of the day, what they're really looking for is a feeling of confidence in their retirement, a sense of security, where they're not worrying about changing laws and tax rates or the economy, or at least not so much. So they can focus on spending time with family and playing with grandchildren. So they can play golf or go fishing without having to keep an eye on the stock market. They don't have to worry that they're making poor financial decisions. This is the true power of wealth planning. If this describes you, I hope to hear from you because you deserve to have a confident retirement too. One final note, these videos are for informational purposes only. They're not meant to be financial or investment advice. Please work with your financial professional, legal team, or CPA prior to implementing any of the strategies discussed on these videos. Until next time, I wish you the best on your retirement journey.